Welcome to the final episode of our five-part series on Israeli exchange rate regimes. Through parts 1 to 4, we have followed Israel from a rigid peg, through a crawling peg, through hyperinflation and stabilization, through horizontal and diagonal flotation bands, all the way to the fully free float adopted in 2005. Today, in part 5, we tell the modern chapter. The story of why the Bank of Israel began massive intervention in the foreign exchange market in 2008. Why Israeli banks were uniquely resilient to the global financial crisis. And how the Bank of Israel's foreign currency reserves grew from $30 billion to over $220 billion, one of the largest reserve accumulations in modern central banking history. The story begins in 2007. Israel had completed its graduation to a fully floating exchange rate in 2005. Inflation was well anchored. The economy was growing. Foreign reserves were about $30 billion, modest by international standards. The Bank of Israel was focused on inflation targeting. The shekel was a normal floating currency. Then the world changed. In August 2007, the U.S. subprime mortgage market began to crack. By September 2008, Lehman Brothers had collapsed. The U.S. financial system was on the brink. Central banks worldwide moved to prevent total collapse. The U.S. Federal Reserve cut interest rates to zero. The European Central Bank cut rates. The Bank of England cut rates. And then came the most consequential policy innovation since the Great Depression, quantitative easing. Quantitative easing, QE, was the Federal Reserve's response to hitting the zero lower bound on interest rates. With rates already at zero, the Fed could not cut further. So instead, they expanded their balance sheet by buying trillions of dollars of long-term treasury bonds and mortgage-backed securities. The Fed's balance sheet grew from under $1 trillion to over $4.5 trillion by the peak of the program. This was, in effect, creating money on an unprecedented scale to push down long-term interest rates and stimulate the U.S. economy. A key consequence of QE was that the U.S. dollar weakened against other currencies. With trillions of new dollars in the system, and with U.S. interest rates pinned at zero, the dollar lost some of its attraction. Money flowed out of dollars and into other currencies, particularly currencies of countries with healthy financial systems and positive interest rates. The shekel was a prime candidate. Now here is something remarkable. Despite the depth of the global crisis, Israeli banks were unusually resilient. They had largely avoided the subprime mortgage securities that had caused the meltdown in U.S. and European banks. They were better capitalized. Their loan books were more conservative. The Bank of Israel had imposed stricter regulatory requirements than peers had. As a result, while major American and European banks were failing or being bailed out, Israeli banks continued functioning normally. Some even reported profits during the crisis. This combination, a weakening dollar plus healthy Israeli banks plus an attractive Israeli economy, meant capital began flowing into Israel. Foreign investors bought shekel assets. Israeli exporters repatriated dollar earnings. The shekel began to appreciate sharply against the dollar. In late 2007 and into 2008, the shekel had risen from about 4.3 per dollar to about 3.3, an appreciation of more than 23% in less than a year. Even more dramatic moves were happening daily. This was a serious problem for the Israeli economy. The high-tech sector, Israel's main export industry, earns nearly all its revenue in dollars but pays salaries in shekels. A 23% appreciation of the shekel meant a 23% reduction in profit margins, all else equal. Tourism, also dollar-denominated, was similarly squeezed. Israeli manufacturers competing with imports faced shrinking margins. The entire export-oriented economy was facing a crisis of competitiveness. The Bank of Israel, under then-Governor Stanley Fischer, responded. In March 2008, the central bank began intervening in the foreign exchange market, buying dollars to slow the shekel's appreciation. Initially, these purchases were small and tactical. By July 2008, the program had escalated to systematic daily purchases. The Bank of Israel was buying tens of millions of dollars per day in an attempt to moderate the appreciation. What's important to understand here? This was not a return to a fixed exchange rate regime. The Bank of Israel did not commit to any specific level of the shekel dollar rate. It did not draw a line in the sand and promise to defend it. Instead, it intervened in the market to slow the pace of appreciation. Officially, the regime was still a free float. In practice, the central bank was reshaping market outcomes through its intervention. This is what economists call a managed float, or sometimes, less politely, a dirty float. The interventions accumulated foreign reserves at an extraordinary pace. From $30 billion at the start of 2008, reserves climbed to $50 billion by early 2009, to $70 billion by 2010, to $100 billion by 2014, to $150 billion by 2018, and to over $220 billion by the early 2020s. The Bank of Israel had become one of the world's most active central banks in the foreign exchange market. Why did the Bank of Israel do this? 3 reasons. First, protecting the export sector, particularly high-tech, which had become 12 to 15% of GDP and the engine of Israeli growth. A sustained appreciation would have damaged this sector severely. Second, building precautionary reserves. Having a large reserve buffer is insurance against future crises, particularly for a small, open economy heavily exposed to global shocks. Third, smoothing volatility. Even within a floating regime, excessive volatility hurts business planning and investment. Tactical intervention can reduce that volatility, but intervention has costs. The cost of holding reserves is that the central bank typically earns less on its dollar-denominated assets than it pays on the shekel liabilities it created to buy them. This is the carry cost of reserves. For Israel, this has been estimated at a few billion dollars per year, a significant amount over the cumulative reserve buildup. There is also the risk of capital losses if the shekel appreciates further. The dollar reserves are worth less in shekel terms. Building $220 billion in reserves is not free. A more subtle concern is the implication for monetary policy. When the central bank buys dollars and pays in shekels, it creates new shekels in the economy. This expands the money supply. To prevent this from causing inflation, the central bank has to sterilize the intervention, usually by issuing short-term debt to absorb the new shekels. This creates a large stock of central bank debt and complicates monetary policy. It is a manageable problem, but it is not free either. The intervention program has continued, in various forms, from 2008 to the present day. The Bank of Israel has adjusted its intensity based on circumstances. During periods of intense appreciation pressure, like during the 2020 pandemic, when the dollar weakened again as the Fed launched another round of massive QE, interventions accelerated. During calmer periods, they slowed. But the basic posture has not changed. The Bank of Israel is willing to act in the foreign exchange market when it believes the shekel is appreciating in ways that hurt the real economy. This brings us to a fundamental question. Is the modern Israeli regime really a free float? Officially, yes. There is no commitment to any specific exchange rate, no band, no peg. But in practice, the central bank's intervention is large and persistent enough to shape outcomes. The shekel dollar rate today is, in part, the result of Bank of Israel's intervention decisions. It is not a pure market outcome. So perhaps the regime is best described as a managed float, a floating regime with active central bank involvement. This is, in fact, the regime that many emerging market and small open economies have adopted. Pure floats are rare. Pure pegs are also rare. The vast majority of countries operate somewhere in between, officially floating, but with significant central bank involvement. Israel has become, in this sense, a model for how a small advanced economy navigates the modern globalized capital markets. Looking back at our 5-part series, what's the deepest lesson? Exchange rate regimes are not technical choices made by economists. They are political economic responses to the problems of their time. Israel adopted a peg when it needed credibility. It adopted a crawl when it needed flexibility. It fixed when it needed an anchor. It bandified when it needed to bridge an inflation gap. It floated when it had matured. And it intervenes today because the world it lives in, a world of massive capital flows, quantitative easing, and currency manipulation, demands a more active approach than pure theory would suggest. Israel's 75-year experiment is a textbook case study because it demonstrates this point with unusual clarity. Each regime change responded to a specific economic problem. Each regime created its own new problems, which eventually demanded the next change. There is no perfect regime. There is only the regime appropriate to the circumstances. And as circumstances change, the regime must change too. We hope you have found this series valuable. Across 5 episodes, we have covered the conceptual framework, the crawling peg crisis, the stabilization plan, the flotation bands era, and the modern intervention regime. If you have followed along, you now understand more about exchange rate regimes than most professional economists who have not studied this case. If you have enjoyed the series, please share these videos with someone who would benefit. And subscribe to Macroeconomics with Michael for more deep dives into how the world's economies actually work. Thank you for watching all 5 parts.